Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are plugging into the backbone of the AI revolution. We're talking about Arista Networks, ticker ANET. And Lana, I have to say, this one's got me fired up.
That's because Arista is sitting right at the intersection of the two biggest spending trends in tech, AI infrastructure and cloud networking. $9 billion in revenue last year, up nearly 29%. This isn't a speculative AI play. This is a company delivering real hardware into real data centers.
And they just raised their 2026 guidance to $11.25 billion. But before we get into all those juicy numbers, let's set the stage. Who is Arista Networks?
Arista was founded in 2004 in Santa Clara, California by Andy Bechtolsheim and David Cheriton, both legends in networking. The company designs and sells high-performance multi-layer network switches built on their proprietary EOS platform, which stands for Extensible Operating System. Think of it as the plumbing that connects servers inside data centers.
Right, and not just any data centers. We're talking about the biggest hyperscalers on the planet. Microsoft, Meta, and the other cloud giants who need the fastest, most reliable switching fabric money can buy. Arista has shipped over 150 million cumulative ports.
What makes EOS special is that it runs a single software image across every product. That means a network engineer can manage 1,000 switches with the same automation tools they'd use for 10. In the AI era, where you need thousands of GPUs talking to each other simultaneously, that kind of consistency is critical.
Now let's talk about the person steering this ship. Jayshree Ullal has been CEO since 2008, and her story is incredible. Born in London, raised in New Delhi, earned her electrical engineering degree from San Francisco State, then a master's from Santa Clara University.
Before Arista, she spent 15 years at Cisco, rising to Senior Vice President of Data Center and Switching, where she oversaw roughly $15 billion in direct and indirect revenue. She was recruited by Bechtolsheim and Cheriton to lead Arista, and she took it from a startup to a $178 billion market cap company.
Barron's named her one of the world's best CEOs in 2018. Fortune put her in their top 20 business persons in 2019, and her personal net worth is north of $5 billion. She's one of the wealthiest self-made women in tech, and frankly, the stock performance under her watch speaks for itself.
Absolutely. She's built an engineering-first culture that prioritizes product innovation over acquisitions. That discipline shows up in the financials, which, speaking of, let me walk you through.
Take it away, Lana. This is your domain.
Let's start with valuation. Arista trades at 46 times trailing earnings and about 36 times forward earnings. The price-to-book ratio is 13.6, and the enterprise value to EBITDA sits at 45.6 times. The PEG ratio is around 1.6. So yes, this is a premium stock, but you're paying for 29% revenue growth and best-in-class margins, not hope.
46 times earnings does make me pause for a second, though. That's steep even for a tech grower.
It is, and we'll get to the bear case on that. But first, let's look at what you're actually getting for that premium. Revenue for 2025 came in at $9 billion, up 28.6% year over year. The quarterly trend tells the story. Q1 at $2 billion, Q2 at $0.2, Q3 at $2.3, and Q4 at $2.49 billion. That's 4 consecutive quarters of acceleration.
Every quarter bigger than the last. You love to see it.
Earnings per share for the full year were $2.75. In Q4 alone, they posted 82 cents per share, beating the analyst estimate of 72 cents by nearly 14%. That's a meaningful beat, not just a penny or two.
What about margins? Because I know that's where Arista really shines.
Gross margin came in at 64.1% for the full year, which is extraordinary for a hardware company. Non-GAAP operating margin was 48.2%. To put that in perspective, most networking companies would be thrilled with a 20% operating margin. Arista is running at nearly 2.5 times that.
And they're not burning through cash to get there, right?
Not even close. Free cash flow was approximately $3.7 billion, which represents about 41% of revenue converting to free cash. The cash flow generation here is remarkable.
How's the balance sheet look?
This is where it gets even more impressive. Arista carries zero long-term debt. Zero. They're sitting on $2.8 billion in cash. The debt-to-equity ratio is effectively zero, and the current ratio is around 4.0. This is a fortress balance sheet by any definition.
No debt, almost $3 billion in cash, and they're printing $3.7 billion in free cash flow every year. That's a war chest.
It gives them enormous strategic flexibility for R&D investment, potential acquisitions, or simply weathering any downturn without financial stress. And I should note, Arista does not pay a dividend. They're reinvesting everything back into the business, which makes sense at this growth rate.
So, what's the overall financial health verdict, Lana?
Overall, Arista Networks' financial health is strong. Exceptional margins, zero debt, massive cash generation, and accelerating revenue growth make this one of the cleanest balance sheets in the S&P 500.
All right, let's see what Wall Street thinks about all this. The Analyst Consensus is a strong buy, with 16 out of 19 analysts rating it a buy and 3 at hold. 0 sells.
The median price target is around $195, which implies about 32% upside from the current price of $148. The range is wide, though. Jefferies has the street high at $380, and Redburn Atlantic is the bear at $112.
Some notable recent moves. Rosenblatt upgraded Arista on April 7th with a $180 target, citing their AI networking strategy. Needham raised to $185, and Piper Sandler adjusted to $175 after the strong Q4 results.
What's encouraging is that there have been no recent downgrades. The upgrades are all tied to the same thesis. AI data center spending is accelerating, and Arista is the primary beneficiary in the networking layer.
Now let's talk about the most recent quarter. Q4 2025 reported on February 12th. Revenue of $2.49 billion, beating estimates of $2.4 billion. EPS of 82 cents, crushing the 72-cent estimate by 14%. And here's the big one. Net income exceeded $1 billion in a single quarter for the first time in company history.
Management also raised the full-year 2026 revenue guidance to approximately $11.25 billion, representing 25% growth. And they bumped the AI networking revenue target from $2.75 billion to $3.25 billion. That's a 117% increase over 2025's $1.5 billion in AI networking revenue.
Now, I do want to flag the insider activity here because it's notable. Over the last 90 days, there have been 62 insider transactions totaling $52.2 million in sales. 0 buys.
That's significant. President and CTO Kenneth Duda alone sold over $7 million in stock through planned 10b5-1 dispositions. One insider reduced their position by over 71%. Now, these are largely pre-planned sales, and executives at high-growth companies regularly take profits. But 0 buys in a quarter does raise an eyebrow.
On the options side, the put-call ratio is 0.85, which leans slightly bullish. Implied volatility is moderate heading into the May 5th earnings report. The market isn't panicking, but it's not euphoric either. All right, let's lay out the bull case. Catalyst number 1, the AI data center build-out is still in the early innings. Arista's AI networking revenue is going from $1.5 billion to a targeted $3.25 billion in a single year. That's more than doubling.
And the technology backs it up. Their new R4 series routers deliver 576 ports of 800 gigabit Ethernet in a single system, and the upcoming 3.2 terabit per second Hyperport platforms enable 44% faster AI job completion times compared to traditional load balancing.
800 gig port shipments tripled sequentially in Q2 of 2025, and industry analysts project 800G will outpace 400G shipments by late 2026. Arista is shipping these products now, not promising them for next year.
Catalyst number 2 is the campus expansion story. Arista's campus and branch revenue surpassed $800 million in 2025. This is a relatively new market for them, and it's growing rapidly. It diversifies their revenue beyond data center hyperscalers.
And Catalyst 3, that balance sheet. 0 debt, $2.8 billion in cash, $3.7 billion in annual free cash flow. They have the firepower to invest aggressively in R&D without taking on any financial risk.
Now, for the bear case. Risk number 1, customer concentration. Arista is heavily reliant on Microsoft and Meta as its top two customers. If either one pauses or slows their data center spending, it could meaningfully impact Arista's revenue trajectory.
That's a real concern. When your two biggest customers represent an outsized share of revenue, you're one budget cycle away from a surprise.
Risk number 2 is competitive pressure, specifically from NVIDIA. NVIDIA's networking unit is scaling rapidly into high-speed AI interconnects, directly challenging Arista's positioning in GPU-dense data centers. And with HPE completing its $14 billion acquisition of Juniper Networks in July 2025, there's a newly combined competitor with deeper enterprise reach.
And then there's the valuation question. At 46 times trailing earnings and 36 times forward, the stock is priced for perfection. If AI spending growth even decelerates, not stops, just slows, that multiple could compress quickly.
Risk number 4 is the insider selling pattern we mentioned. $52 million in insider sales over 90 days with no offsetting buys doesn't necessarily mean the thesis is broken, but it does warrant monitoring. And finally, rising component costs and potential tariff impacts could pressure the 62 to 63% gross margin guidance.
So both sides of the argument are compelling. The growth is real, the margins are exceptional, but the valuation requires continued execution on the AI thesis. Let's see how Arista stacks up against its peers. Cisco Systems is the obvious comparison, the legacy networking giant. Cisco trades at about 28 times earnings with 9% revenue growth and a $325 billion market cap. Cisco's forward PE of 18 is literally half of Arista's, but you're getting 1/3 the growth rate.
The margin gap is even more telling. Arista's operating margin of 48% dwarfs Cisco's 23%. Cisco is more diversified across enterprise, security, and collaboration, but in pure networking performance, Arista runs circles around them.
On the other side, HPE plus Juniper is the new combined competitor. Before being acquired at $40 per share, Juniper traded at 38 times earnings with about 7% revenue growth and sub 7% margins. That's a very different business profile than Arista's.
The key takeaway from the peer comparison is that Arista commands a premium for a reason. Nearly 29% growth, 48% operating margins, and zero debt. No peer in networking comes close to that combination.
So here's the bottom line on Arista Networks. This is a company executing at an elite level. $9 billion in revenue, nearly 29% growth, best-in-class margins, zero debt, and management that just raised guidance for both total revenue and AI networking. The AI data center build-out is the defining infrastructure cycle of the decade, and Arista is the networking backbone making it work.
The single most important number to watch going forward is the AI networking revenue trajectory. Management targeted $3.25 billion for 2026, up from $1.5 billion in 2025. If they hit or exceed that, the premium valuation is justified. If AI spending slows, the 46 times earnings multiple is the first thing that cracks.
Before we wrap up, I've got a quote that feels perfect for Arista. Alan Kay, the legendary computer scientist, once said, "The best way to predict the future is to invent it."
And that's exactly what Jayshree Ullal has been doing for 18 years. She didn't wait for the AI networking opportunity. She built the platform that made it possible.
All right, before we go, if you want the full financial breakdown, charts, and PDF companion for this episode, head over to chargedalpha.com. Every episode gets the full treatment, script, charts, and deep dive PDF, all free. That's chargedalpha.com.
And remember, we don't give financial advice. We give you the facts so you can make your own informed decisions.
That's our deep dive on Arista Networks, ticker ANET, episode 121. I'm Hudson Thomas.
And I'm Lana Chen.
This is Charged Alpha, the S&P 500 stock encyclopedia.
Facts first, always.
The information presented in this podcast is for educational and informational purposes only and should not be construed as financial advice. We are not financial advisors. Always do your own research and consult with a qualified financial professional before making any investment decisions.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.